Hello, savvy viewers. We're back with another exciting exploration into the fascinating world of finance and taxation. Welcome to Finance IQ 101. Today, we're going to dive into the exciting world of wealth management. Get ready for a fascinating journey as we navigate through the intricate maze of managing your money. Let's get started. Have you ever thought about how the rich and powerful figure out ways to handle their taxes and legally reduce the amount they owe? Oh, you're in for a treat. In this super interesting episode, we're going to dive into the fascinating world of how the wealthy elite managed to legally avoid paying taxes. Grab your notepads and hit that subscribe button, because we're about to dive into the fascinating topic of how the rich avoid paying tax legally. Let's uncover all the secrets together. Let's start with Warren Buffett, billionaire and CEO of Titan companies, such as Berkshire Hathaway, who profoundly transformed our notions of investment and wealth creation. Buffett's name is associated with luxury and unrivaled commercial success, and he stands not just as one of the world's wealthiest individuals, but also as a financial titan. Berkshire Hathaway, on the other hand, is an exception to the rule as a result of Warren Buffett's great management. It functions as a financial behemoth, acting as a holding corporation that exerts its power via a wide variety of subsidiary companies. Imagine it as a massive organization that has stakes in a wide variety of potentially fruitful businesses and industries. Its crown jewels include Geico, a top insurance provider in the industry, Dairy Queen, a popular ice cream and fast food chain, and a big position in a major railroad firm. Geico, Dairy Queen, and a considerable stake in a major railroad corporation are all among its assets. Berkshire Hathaway's investment portfolio includes major interests in global heavyweights, such as the beverage titan Coca-Cola and the technology behemoth Apple. But the story doesn't end there. This is where the magic lies. When Berkshire Hathaway's subsidiaries are successful, the stock prices of those subsidiaries rise, and as a direct result, the value of Berkshire Hathaway's shares follows suit and skyrockets. It's quite similar to basing your own success on the achievements of another person. In the year 1965, when Warren Buffett took over as CEO of Berkshire Hathaway, a single share was priced at only $1.19. The identical stake now fetches a price of over $500,000 when it's put up for sale. To put that into perspective, Warren Buffett is the owner of more than 240,000 of these shares, which practically make up the majority of his enormous wealth. However, when comparing the amount of tax burden faced by Warren Buffett and his secretary, there is a striking imbalance that appears. Buffett has been quite public about his disapproval of this inequality. Buffett's tax rate is far lower than that of his secretary, despite the fact that he is one of the wealthiest people in the world. What is the cause? Various tax duties are required. When it comes to taxes, Buffett is largely responsible for paying capital gains taxes on the proceeds from the sale of his stocks, while his secretary is obligated to pay income taxes on the money she earns. This gaping chasm is illustrative of the growing problem of wealth inequality, which arises from the fact that capital gains are often taxed at considerably lower rates compared to income taxes. In recent decades, there has been a concerning widening of the wealth gap in the United States. When adjusted for inflation, the after-tax income of the richest Americans has increased by more than 400% over the last 40 years, while the post-tax income of those in the middle class has increased by just a paltry 50%. The discrepancy in income has been a crucial factor in the development of the wealth gap that has emerged. The ways in which the wealthiest people in the United States accumulate their fortunes are strikingly unlike to the paths taken by the majority of American workers. This distinction is reflected in the varied tax rates paid by these groups of people. In spite of the fact that he has achieved more financial success than other people, Warren Buffett maintains that it is unethical for him to pay lower taxes than other people making the same amount of money. Now let me introduce you to Edward Morris, a man who used to work on Wall Street but has since retired and now makes his living off of considerable assets in the stock market. Morris exemplifies those in the top 1% of the population with a portfolio that is loaded to the gills with shares in firms such as Berkshire Hathaway, Amazon, and Apple. However, what sets Morris apart from the other candidates is his constant support for increasing taxes on the rich. He has a vision for a society in which a vibrant middle class is able to support local enterprises, so contributing to economic stability and shared prosperity for everyone. The primary factor that determines a person's level of taxable income under the present framework is their source of income. People like Morris earn a significant percentage of their income from their assets, the majority of which are comprised of stocks and real estate. While the majority of Americans make income from normal work and pay income taxes ranging from 10% to 37%, Morris and those like him derive a large income from investments, which are subject to capital gains taxes but provide significant savings on taxes over the long run. For example, long-term stock investments are only subject to a maximum tax rate of 20%, which is a significant decrease in comparison to the income tax rates that regular employees are responsible for bearing. Consider Morris as an example to explain this disparity. Recently, he sold equity worth $400,000, which resulted in a tax liability of around $50,000. He is now responsible for paying this tax. In comparison, an individual who maintained a yearly income of $400,000 via consistent work would be subject to a substantially higher level of taxation. In addition to this, a significant portion of Morris's fortune is not subject to any kind of taxation. People like Morris and Buffett have accumulated a significant portion of their fortune via intangible assets, notably stocks, which are free from immediate taxes. These types of assets include intellectual property and business goodwill. Only when these assets are sold will the associated taxes become due. The vast majority of Jeff Bezos's fortune was accumulated via the ownership of Amazon shares. Bezos is the CEO of Amazon and is ranked as one of the richest persons in the United States. The manner in which Bezos and many other billionaires have organized their wealth in order to minimize their tax liabilities sets them distinct from the typical taxpayer. Bezos is exempt from paying immediate taxes on the great bulk of his wealth, which consists of Amazon shares. This is in contrast to the majority of individuals who are subject to yearly taxes based on their income. This one-of-a-kind tax benefit results from the fact that these shares are regarded as an unrealized capital gain until such time as he decides to sell them. This process is the key factor that permits billionaires like Bezos to amass tremendous fortunes while paying taxes at rates that are quite modest. These very affluent people may avoid paying taxes on their earnings forever if they do not sell any of their assets that have increased in value. In the case of Jeff Bezos, this has made it possible for him to continue expanding Amazon without the weight of huge annual tax obligations. As a result, he has been able to leverage his fortune to produce even more wealth. Because this practice seems to favor the ultra-rich while possibly robbing public coffers of much-needed cash for social programs and infrastructure development, it has created arguments about the fairness and efficacy of the present tax system, which has raised concerns about income disparity and spurred questions about the fairness and effectiveness of the current tax system. The taxation of capital gains and unrealized income continues to be a significant topic of dispute in the continuing conversation about the distribution of wealth and the fairness of the economy, even as negotiations about tax reform continue. Some billionaires, like Elon Musk, go it a step further by using their stock holdings as collateral for loans, which enables them to continue living lavish lives without having to sell up their assets. They are able to keep all of their riches thanks to this technique. There are no share transactions, thus there is no additional tax burden. It is possible for billionaires to avoid depending on traditional income by placing their money in assets that increase in value over time. This enables them to live an extravagant lifestyle without worrying about money. In addition, the stepped-up basis provides a large tax loophole within the scope of the capital gains tax. If Warren Buffett were to sell his shares during his lifetime, he would be subject to paying capital gains taxes on the proceeds from the sale. These taxes are calculated based on the difference between the current value of the stock and the original purchase price. This is the part of the code where he would be responsible for paying these taxes. If, on the other hand, he keeps these stocks until the day he dies, his heirs will only have to pay taxes on the gains they make after inheriting the assets, provided that they do not sell them before he does. As a consequence of this, the vast majority of the initial profits are not subject to taxation, which enables the richest families to pass down their fortunes from generation to generation. Legislators are presently conducting an investigation of this system, specifically focusing on the unequal distribution of benefits regarding the taxation on capital gains among the top 1% of earnings. As a direct result of this, there is a growing push to alter taxes on capital gains, with the objective of more fairly distributing the burden of paying taxes. For example, President Biden has suggested closing the stepped-up basis loophole and raising the maximum tax rate on capital gains from 20% to 39.6%, although this would only apply to those whose annual earnings are more than $1 million. A huge increase in tax collections, which proponents say may range from $200 billion to twice that amount over the course of a decade, is one of the potential benefits of this proposal. Critics, on the other hand, are concerned that such regulations might limit the number of people investing in the stock market or cause millionaires to reduce the amount of shares they sell. Those who are in favor of it argue that it has the potential to significantly boost tax revenues and address the obvious inequity that exists between Warren Buffett and his secretary. However, it is essential to recognize that even if these changes are put into effect, a significant percentage of the income of billionaires would still be exempt from taxation. This is due to the fact that a sizable portion of their money remains locked up in unrealized capital gains. In order to achieve true tax justice, it is possible that more fundamental changes will need to be considered. These reforms may include taxing gains made on wealth and stock markets. The idea that wealthy people are not paying the amount of taxes that they should be is becoming upsetting to the vast majority of Americans. And altering the rates that apply to capital gains is only one component of a much larger and more complex issue. The existing economic system has contributed to a widening wealth gap by allowing the affluent to collect bigger fortunes while the rest of society struggles to keep pace, which has resulted in an increase in the number of people living in poverty. The effort to create a society that is more equal should begin with fundamental changes to the way taxes are collected on capital gains. Even though resolving these inequities offers a monumental task, doing so is still something that must be done. Thank you for watching, and feel free to share your thoughts and questions in the comments section below. This channel is here to provide insights and information to assist you on your financial journey. Remember to subscribe to our channel for more valuable content on wealth-building strategies. Until next time, stay financially savvy and make the most of your financial opportunities.